Okay, so I did something I've never done before, and I interviewed two legends in the same day. And the conversation that I had with Rodney Clark, who I think his career in investment banking and fundraising in CPG spans the course of 3 decades. And I met Rodney. I met Rodney years ago. Was introduced through a friend of a friend, and I happened to be doing some traveling, and Rodney said, "Hey, where are you going to be on this date? And I'll meet you there." And I was in Salt Lake City, and I remember we had sushi, and we got to catch up and get introduced. But Rodney jumped through some hoops to come meet me that first time, and I thought that was pretty remarkable. But Rodney helped me navigate a pretty extensive fundraising process 4 or 5 years ago, a successful fundraising process. And he's done that many, many, many times in his career. And so I thought his perspective would be really important in this series that we're doing on fundraising and CPG fundraising. And so, Rodney runs more of a boutique operation with his investment bank, but he's been a part of the big banks too. And so he's seen both sides of that equation. So we're going to talk about the current fundraising environment, the various challenges that present themselves today. We're going to talk about valuation trends and methodologies. We're going to talk about, what the market dynamics mean for strategic acquisitions today and maybe in the future. We're going to talk about navigating investor relations, the various mistakes that entrepreneurs might make in their processes, and perhaps some of the mindset shifts that should take place. When to seek that kind of professional guidance. I don't think that's for everyone. And then Rodney will give his take on the trends that he's seeing in CPG that he's bullish on, and maybe some that he might be bearish on. And in general, just the opportunity to speak to a person of this caliber and to hear from them is worth its weight in gold. And so I think you're going to really enjoy this one. Thanks for listening. Take notes. Let me know what you think. All right. We are here with my friend, Rodney Clark from Aspect Consumer Partners. And this one is really great for me because I got to work really closely with Rodney in a fundraising process and got to kind of see how this whole process works firsthand, and how Rodney operates in the trenches, and how he deals with the investors and manages a fundraising process. So I got to learn an extraordinary amount during that process, and we were successful. So, we had a successful fundraise, kind of in a very early post-COVID life. For context, we were going to start a process before COVID, and then the world kind of shut down. And so we got to talk every other week for all of 2020, trying to figure out, when is the right time and who is the right, set of people. And so, I think we delayed our process by about a year when the entire world shut down.
Right, yeah.
And then got to get going. So I'm really excited for this conversation. Rodney, thanks for being here. Will you just give us a quick 30-second introduction on yourself and how you got to the point where you are today?
Rodney Clark, Aspect Consumer Partners, as Jason had said. We're a boutique investment bank, and we help people with M&A, capital raising, other strategic matters. And I've been doing this for most all of my professional career. Jumped out of the big banking platforms about, I guess we're going on our 13th year now, to start my own business with a partner. Always had in mind while I was at those business, big banks, I saw how they were doing it. And I always had in mind that Dr. Seuss book, the things I would do, that comment, the things I would do if I ran the zoo. And was itching to get out. I'm not an entrepreneur by trade, but just wanted to get out, and I thought we could do it better. And so we started Aspect 12 or 13 years ago, and just been fortunate enough, Jason, to work with people like yourselves and be successful on a number of different transactions and just having a lot of fun while we're doing it.
Rodney, are you free? Are you at liberty to just tell me a couple of those things that you would do or that you decided to do that were different in the boutique world versus in like a larger investment banking platform?
The main difference is just our corporate DNA and aspect, and why my partner Sean and I started the firm. It's just, we thought, and we still think, the world of financing and M&A and the like, it's just broken. It's conflicted. There's crappy advice. There's conflicted advice. And what I always thought, and what I always, wanted to fix or make sure, is I focused on the client and giving solutions to the client, helping them break this kind of asymmetrical information that's out there, where the VCs and the private equity and the strategics have all of the data, and they go around, they speed date everybody, and they use it to their advantage. And you, as the little entrepreneur and owner, mid-size, you built a big $50, $100 million business, you're at a loss because they know pretty much everything and you don't. We decided to go out there and try to correct that and work with owners and entrepreneurs and give them the right advice so they could make the best informed decision equal to the people who are investing in their businesses when they needed to. And that's important for the success of those businesses, we thought.
Got it.
And that's kind of the main difference.
And
sorry to interject. Before, it was all about, and this is what still most of my brethren in investment banking are about, it's usually about just getting a transaction done, getting a paycheck, and then get paid like an investment banker. And we just thought that's broken.
Got it. So the far less purely transaction oriented. And I would say that was my experience as well. This felt like we were really locking arms together, and we were going to go row this boat together, going through that process with you. Rodney, just for context, so people have it, at what scale and at what size does a brand need to be, before it makes sense to engage with someone like you in the investment banking world to go raise money? I mean, this isn't, hey, Rodney, can you go help me raise $1 million, right?
Yeah. I mean, it just depends. I'd say there's, and by the way, I didn't mean to bash banks that are transaction focused. That's one way to go about it. We thought the better way to go about it, for us at least, was to focus on client solutions and offering them the best creative advice that they could, so they could make the best informed decisions. So,
well, let me help you here on that one too, because here's the thing: whether they're transaction oriented or not, no one says they are. Yeah, everyone says that they're focused on people, sure. and we all know that there are plenty that are, and that's okay. I mean, again, whatever lane you decide, whatever lane you're in.
Yes, for sure. And then, so to address your question about size, it really depends on, because there's all sorts of sizes of banks, and you'd work with different banks that focus on different sizes along your corporate life cycle, right? So if you're a really small company just trying to raise some funds, your past friends and family, but you just want to raise $1 million, you're not going to work with a bank like ours, or, one of the larger, bigger banks like Morgan Stanley or Goldman Sachs, or they're going to work on $1 billion transactions, right? There's banks that'll help you all along. You just have to find the right fit for someone who won't charge you too much, has contacts and has relationships in the size range that you're looking, and will lean in and do the work that'll get you what you need.
Got it. I see some plaques behind you for some, some deals that have been done. Looks like I see my friends over at Siete there. I see a late July snacks plaque. Oh, and then there's that one that we see for the new Primal. What are you seeing? What are you seeing today? you've been doing this 25, 30 years, 13 in your own firm. What's different about the environment today than it was 5 years ago, 10 years ago?
Good question. Good question. So, I've been doing this a long time, so we see these cycles and the ebbs and flows. I would still say we're kind of in that longer tail of the shock of COVID and kind of working through that still. So it's not the greatest or the easiest environments right now to do fundraising or M&A. And just as we were coming out of that, we changed into a new administration. And whether you're supportive of the new administration or you're not, that's not relevant to the discussion. What never helps the deal environment is significant volatility. And we've got so much volatility right now. It's, putting a damper on the activity. It's causing causing transactions to have an elongated time frame in which they get done. It's causing more scrutiny by the investors and the buyers and the acquirers. And it's making things more challenging. So what's going on right now that's different? As we were just getting out of the COVID kind of malaise, we went into this period of volatility that's really an unforced error right now. And we're just kind of mired in that. So hopefully we'll be able to get out of that. We thought coming into the year, this year would be great for deal activity, and we'd be back to some smoother sailing, higher velocities of transactions, people leaning forward on valuation and the like. That just hasn't happened just because all the volatility we're experiencing. The other thing I'd say that's pretty interesting in consumer that we've seen that has caused challenges is, and this is just a thing we talk about at Aspect, but Amazon buying Whole Foods and then changing that more to an Amazon-based model than a Whole Foods model where small entrepreneurial brands could get on the shelf and customers would go for the customer experience and exploration. That's gone away. And people are trying to find and having a harder time to find where are people trying our brand? Where can we initially engage with them to build that brand? And that seems a lot tougher in this environment. And that's not necessarily COVID related. That's kind of how the tectonic plates of the industry changed and Whole Foods got taken up and they used to carry the banner on that.
As someone, we got really lucky working with Whole Foods 10 years ago and built some really incredible relationships there. And we're fortunate to occupy a decent amount of shelf space. But I will say that from a local emerging brand standpoint, it is a much more difficult path, it feels like today, than it was a decade ago when you had these local foragers who were actively seeking out, the farmers market brands and the ones that had legs and trying to bring them in and sort of foster them into the system. That isn't really there as much today. And then I would say even for brands that are on shelf and have some scale, the just-in-time inventory management aspect of how they operate today has become a little more difficult to execute on promotional strategy and so forth. So, yeah, I would say that certainly, I think, impacts the pipeline of new and exciting brands and perhaps the pipeline of innovation. And I think people have had to be creative and figure out other ways to go to market versus having, Whole Foods be that pillar that was sort of adopting all of those early stage brands in those days. That's shifted today. And I think that's just, to your point, a function of, hey, look, they were acquired by a bigger business. They had to adapt. The business model shifted a bit. And so I would agree with that sentiment wholeheartedly, that it is more difficult for those early stage brands to gain real traction there.
Yeah, as well, layer on top of that. And it's not necessarily a negative. It's just, hey, we got to, like you said, be a little more creative in where we find our space and our lane. But then layer on top of that, one of the effects of COVID that brought it probably sooner quicker was, the Instacarts of the world where you're trying to manage that both from an economic standpoint and in, getting your brand in front of your customer. So it's trickier. And I guess what I'd say to your question was, let alone the effects of COVID and trying to get through some of that stuff. It's more complex out there right now for a younger brand to kind of try to succeed and engage with its customer and get what we would say at Aspect is, get that permission from the customer to build your brand.
Yep.
Which is really what you're striving to do. I
would agree with that sentiment. I mean, it's just a different world. Knowing what I know, and in hindsight, if I were to start over today, I know exactly what I would do, but it's different from what I would have done. What I would say I would do differently if I were to start again back then, because the world has evolved. So, I think that leaves an opportunity for most people. Sure. I take that viewpoint, but it isn't the Whole Foods will give me a local store and I'll prove myself, and then I'll go to the region and I'll prove myself, and then I'll go to all regions. That was one path once upon a time. I don't think it's that simple anymore.
It certainly doesn't seem that way.
No. I want to go back to the difference in the fundraising environment, though, for a second, because you're on the phone with investors all the time. You're on the phone with strategics all the time. I want to talk about valuation for a second.
Yep. Always a tricky issue.
It's an art and a science, right? And I've had a couple of investors on now for this season of interviews, and the answer is I've been doing this 13 years now, Rodney. So I've been on my own for 13. You've been on your own for 13. No one ever has a straight answer to this question, so I don't expect one here. But how have valuations changed in the past 5 years? From where they were in let's say a pre-COVID world to where they are today, in your view?
Yeah. So tricky question. I'm going to go at it a little different way. So valuation and the methodologies used and how you look at valuation really never changes. What changes is the environments in which we find ourselves trying to value our own business, another business, a business we want to invest in. And given the environment and what you're doing, there may be differences that hit that business in a certain way that cause it to one time be valued like this, but another time to be a little bit challenged, be valued a little bit less, or to catch fire in another environment and be valued very highly. The methodologies are all the same, but you pull and push different levers to get at kind of where the valuation is at any one given time. And I know that's kind of a roundabout way to say it, but really valuation doesn't change in the fundamentals on how to calculate it. It's just a matter of, for example, 2021 came out of COVID. 2021 was a barn burner of a year. Get into 2022 and 2023, lower growth rates, significant challenges, still seeing supply chain issues. So when investors were going to look at businesses, they were highly more critical. Evaluations were probably lower because growth rates were lower. Things were a bit more challenging. But that compares to just a year or two earlier in 2021, where you came out of the doldrums, growth rates were off the charts. Investors had to figure out, is this the COVID bounce? Is this real? How do I look at this? But anyway, you looked at it, the numbers were way up. And so valuations floated up with all that positive sentiment and the higher growth. And so it's more, probably valuation is more a matter of, the timing and the environment and where your business is within that environment will drive what type of valuation you can get ascribed to that, is what I'd say.
So are valuations lower or higher today than they were pre-COVID?
Valuations are trickier and lower today, except for those guys that are really outpacing the market. There's no question they're just blowing the doors off it. Right now, it's a trickier time for sure. Okay. And that's in in an environment where there's higher volatility, there's more caution, people are leaning less forward, and there's less confidence, and maybe some slower growth rates or growth in certain channels is more difficult to come by, valuations are going to come down with that amid that environment, for sure.
Fair enough. Would you say growth rates in some places are slower because people aren't able to raise the fast, easy money and just throw it at top line growth? Do you think people are having to run more fundamentally sound businesses, which has a more measured growth to begin with?
That's a good question. I'd say in these more challenging times where there isn't as much capital, but also in times where the investors or buyers are more wanting you to focus on profitability as well as growth, that's going to temper your kind of overall growth. And growth is a high indicator of multiple that you get. And so, yeah, valuations would come down, again, amid that environment because of that. And look, I've been on this rodeo a few times now, the tech boom and bust, the Great Recession, COVID now, and seen all these. We're in that period post a big kind of traumatic event, and we're kind of muddled in that area. We haven't come out of it yet, and we're still in challenging times for the majority of names that are out there looking to get financed and the like. It's only really the high flyers that are going to get a really attractive multiple in this environment. But that's okay. That's okay. Here's the other thing I'd say. Owners and entrepreneurs always are like, I'm not getting that big investment like Siete got when Stripe's invested in them or some of these other big deals. That's okay. That's okay. Because you might get it as you move forward in the corporate life cycle at a later date, assuming you can perform and the like. And valuation isn't, except for how much equity you have to give up in and around valuation, it isn't and shouldn't be the main determinant of if your business is successful or not, or doing all the right things.
Yeah, I think we get caught up in it. I think everyone gets caught up, even in early stages, and even when you're trying to raise friends and family money, sometimes people, entrepreneurs tend to overvalue what they're building. And the market sometimes undervalues it. And so the answer is usually in the middle if you can come to that agreement. But I think that there are a lot of entrepreneurs that, kind of base their own self-worth on what kind of valuation or valuation multiple they can get on the business that they're building. And there's a lot of factors here that would that come into play. Rodney, there's I made a prediction last August that was equally applauded and scrutinized. I made it on LinkedIn. I've been really active on that platform for the past couple of years. I've seen that. Yeah. And it was last August. I said big acquisitions are about to come in hot and heavy. I remember that. Yep. The sentiment was that there's just been a pipeline that hasn't happened. Now, I count at least a dozen that have happened since then, and they're big ones. Yeah. So there's a couple of smaller ones from strategic buyers that have come in there. I think was it the candy, the sweets? What was the brand? Anyway, it'll come back to me. In my space, ConAgra acquired Fatty, which would be considered a smaller deal in the grand scheme. Still big. I mean, but smaller. And then you've got the Simple Mills and the Ghost Energy and the Siete and the PepsiCo coming in and doing the $1 billion plus acquisitions. Yep. Are you seeing any trends, one way or the other, towards, you said high flyers earlier, and that can mean a few different things, but are those the deals that are getting done today from a strategic acquisition standpoint? Are these like much more mature brands that have created and reached some level of really big scale where the Krafts, ConAgras, and PepsiCos of the world want to come down and acquire them? There was once upon a time, there was this magic goalpost of $100 million. If you could get to, $100 million of revenue with some EBITDA, the world is your oyster and you'll have multiple offers at the table. Is that still true? Has the goalpost moved further?
Yeah, so we always get that question. I always hear it in different ways, and it's 30 million, it's 50 million, it's 100 million. Um, you know, I'd say amid this challenging and volatile environment, yeah, the bar always moves up. The bar in profitability moves up. The bar in how you manage and you're efficient moves up. And we're in that zone right now. But is there any real given size that you have to be at? I'd say no, because there are some small and mid-sized deals in around 40, 50 million that get done. We're probably not in an environment right now, but I think the key is for those smaller mid-sized brands that are below 100 million is, do you have a pathway to get to be 100 million, 200 million, $300 million brand? And can you articulate how you're going to do that to someone? And then a smaller brand can do a transaction with the strategic. So
Got it.
But there's no tried and true number that you have to be at this level to get there. We would always say, you just need to build the best, healthiest, and most durable brand and business you can, and it will happen on the back end. And all the other stuff, you really don't, is just noise. And that could be at 30 million, that could be at 60 million, that could be at 150 million. So
you just gave me such a good clip. It's such a good one line. It's such a good line. Build the best, most durable brand you can build, and the rest will take care of itself.
Yeah, we talk to a ton of people who are more worried about where the multiples are and everything. And I would tell them, hey, take all your time and focus on building your brand, knowing who your customer is, where they eat and breathe, what your brand is. A brand's is kind of amorphous concept, right? That moves and grows and expands and contracts. And you got to find across different areas of distribution and customers where it eats, lives, and breathes. And once you do, that's where you really find something unique. Then you throw all the capital at it and blow it up and see where it can really get to. But too many people focus on, oh, I'm building this brand and we're going to sell it in 5 years and here's the multiples and that's why we're going to make everybody really rich. We shy away from working with those types of owners, entrepreneurs, and companies who aren't there to build this lasting, durable brand.
Got it.
You can sell those, no question about it. We've just found that those aren't the wins, long-term wins at the end of the day.
You know, I had a conversation last year with A-Rod, Alex Rodriguez. I had a couple conversations with him, and you know, he's become kind of a prolific entrepreneur. And through a connection to another connection, we happened to find ourselves in a phone call with each other, and you know, A-Rod said this to me. He said, you know, the lens you should look through is 30 years. He said, build like you're building for the next 30 years and the rest will take care of itself. And I think that's it, Rodney. I think what happens is what you said. People get caught up in this. Oh, so-and-so, you know, built a brand and in 4 years they sold it to so-and-so for a 4X multiple. We're going to go do that. And I think they see these like one-off, unicornish, or maybe they think it was 4, but it was 10 because they didn't see the previous 6 where everything got screwed up. And I think we all get this like very condensed timeline in our head. And I think the lens to look through on this stuff, for at least what I've, you know, where my mindset has shifted is like, this is a long game and nothing is as fast as you think that it is. And so to the extent you can build a durable, lasting brand with a healthy P&L profile and products that consumers like and come back to over and over and over again, the rest takes care of itself. I think we try to over strategize the exit is what I'm getting to. Absolutely.
Absolutely. And strangely enough that you mentioned it, I'm not going to get the details right here, but last December down at NOSH, they asked me to give a talk, and I gave a talk about, we went back to PitchBook and FactSet data and looked at all the consumer deals over the last like 20, 30, 40 years. I think we ran them back to the early 1900s to try to look at, you know, can we tease anything out of kind of ups and downs in the market? And is there anything different now that we would tell people? And what we saw, Jason, was one of the takeaways that we serviced up in that was everybody thinks your brand's going to be around for 3 or 4 or 5 years, and then you hit it big. What it looked like from the data was most companies have 9 to 11 years, kind of was the range before they had that significant event. And we denoted significant event of a significant capital raise, not just a couple $1 million, but a significant kind of recapitalization, capital raise, or a sale of their business. And that data seemed to show exactly what you're saying, which is you've got a long time to go at this, and you got to build something that's durable.
Yeah. This is where I talk about mindset a lot, because your mindset has to be there. And and it has to be in a place where you're ready to take the punches. You're ready to, continue to get back up every time there's a failure. I mean, this thing is this isn't an overnight thing. No business really is. And so, from an entrepreneur standpoint, the long view, I think, is really, really important. And just know you're going to keep getting up over and over again and keep chopping wood. I mean, that is sort of that's been my story, and I would call us relatively successful so far. Plenty of wood to chop, but
yeah, I was going to say, related to your story. I mean, look, we've known each other for a long time now. We helped you raise capital. You had to build your business through all the noise in, let's just talk about the meat snack side. All this noise, private equity coming in, Epic selling to General Mills, like all these things. And you had to just put the blinders on and keep coming in and going, I know this is where we're positioned. I know this is what we're doing. And I tip my hat. You built a fantastic business. It's now sizable. You got the Snack Mates piece that, by the way, just this morning we got delivered the rotisserie flavored sticks. So
oh man,
we're going to do a family taste test later today. But my son in particular eats through those Snack Mates like they're going out of style. But the rotisserie chicken is something I think the whole family could maybe engage. But back to the thing, you've had to wait till all the shiny new pennies get a little less shiny, and you're one of the few guys in meat snacks on the healthier, better for you bent that's successful, right? And that's just putting the thing on your back with the team and carrying it forward.
Yeah. Yeah, that's it. And I think that's the grit and the mindset most entrepreneurs need to have. Wherever I've always taken this view that wherever I lack in IQ or experience or any of that, we're gonna offset it with grit and resilience and sometimes patience, which is also really hard to do.
And that's why sometimes I worry about our calls, because I'm like, Jason's got that entrepreneurial, positive, gonna keep going. And then I get on the phone with him in the last 5 years and it's gloom and doom and the like. And he's like, oh my God, just let's correct out the noise and keep moving forward.
Yeah, that's the only way I know. One of my favorite authors is John Acuff, and he wrote a book called Soundtracks. Okay. And he talks about, picture in your head. You've got to turn down the noise and the negativity, and then you have to then find a new soundtrack, whether that's in a book or a podcast or, whatever it might be, where you're, replacing that. You can't just say, I'm not going to think negative anymore or have any of this stuff, but you have to kind of adjust the soundtracks. And I always think that's
well, and so mindset. So you hit on it. And one of the things we were talking about before was, what kind of topics can we talk about here? But, when we go out and look to work with clients, the reason why when we had our meeting, that first, in-person meeting in, I think it was in Utah, I noticed the mindset over and above great business, like the positioning, all of that. It was mindset. I was like, this guy's going somewhere. He's backable and, got a great business along with it. And those two combinations, the business with that mindset, I think are really important to be able to attract capital, especially in the environment like we're in now.
I appreciate you saying that. Thank you. A conversation I had earlier with a private equity investor. I asked him what are some of the things about entrepreneurs that he looks out for in his conversations when they're vetting, and the answer was around coachability, but it was like, I'm looking for someone who's coachable, who's not just going to push the negative stuff to the side, but willing to put it on the table and say, let's work together to fix it. And I think mindset and the entrepreneurial side is really important beyond the numbers. So I appreciate you highlighting it. I want to pivot for a second. There's a handful of questions I want to make sure I get out of you if possible.
Sure.
Because I think you have just such a great perspective on this.
As long as it doesn't get too deep, because I still have a firm to run and don't want to get in trouble.
Someone told me don't be a flamethrower once upon a time on LinkedIn, so I stopped throwing flames. But what are some watch outs for companies and brands and people like me? What are some watch outs for them when they go to raise money? What are some things they should be on the lookout for to ensure they don't just get taken?
Yeah, good question. So there, I'd say that's a tricky one because, and not because investors are bad people or anything, but that's one where the owner entrepreneur isn't necessarily aligned with the investor, right? They're looking for the best deal, which means buy low, sell high, right? So they're looking to buy low, and you're looking for the best and fairest deal, which may not hit that buy low piece. So you've got to find someone who's aligned with you along the terms of how they would invest and think of investing and then making money on the back end, because everyone has to talk about an exit, and make sure you're aligned there just up front with how they're thinking about it. And you can see right away if someone's just going to be, I want the lowest deal I can. I'm going to grind these guys out and I'm going to buy low, and then we're going to push them as hard as we can and sell it as high as we can. We're going to do that as quickly as we can. And we'll financial engineer maybe in the middle of it. And you'd say, that's a style. It may or may not work with your style. And you gotta find that fit and that alignment. Conversely, there could be someone who's more of a longer term kind of family office, and you might think, gosh, my business is just about to take off. We really need someone who's going to come in and be catalytic and throw some capital on this and really push so we can move quickly. And someone who's moving slower and is a little more conservative and doesn't want to do that, that's not a fit. So I'd say, first of all, when you're talking with people, you got to find that fit. And you got to be aligned on that first and foremost.
The big takeaway there is that the entrepreneur should do as much vetting of the investor as they do of the entrepreneur, and ensure that everybody's priorities and goals do align. Because
Here's the tricky part, though.
Yeah, it's very tricky.
Sometimes, as an entrepreneur, you just in the end have to get that money in, and so you got to realize that, okay, I'm going to make some sacrifices, but what are those sacrifices and where are you willing to sacrifice? And are those deal breakers or not deal breakers? That's where I see it's a little tricky. Yeah.
Yeah. It's a nuance. There's no straight line to that, but I think to your point, right, get aligned first and then, all right, well, maybe we're not fully 100%, maybe we're 90% there and there's going to be some give and take. And can I live with that? I think is an important answer to have. One of the things that's interesting to me in my experience, and it may just be that I don't have enough experience, so you can tell me this too, but in my experience, why don't more private equity groups or venture capital firms, why don't they hire more operators to help them? They're full of brilliant financial guys, brilliant MBAs, brilliant guys that went to Ivy League schools that, man, I mean, they can work a spreadsheet like no one's business. But why don't they hire more guys that have just grinded it out in the trenches?
That's a good question. I haven't asked. I'll come back to you, 2 months after I ping a few people, private equity guys, and we can have a different conversation on it. But I guess, so this is just speculation, but one, you probably have to share some of the economics, but that's probably smaller. Right? You get somebody outside the firm to come in, they're going to get some of the economic pool. But I might also guess when you're a private equity firm investing and going to invest, if you're depositing in your own management, or that's probably a riskier situation than it is finding that business with the team already in and just supplementing a couple people and you're off to the races. And my guess would be, a couple of those. Maybe there's some other issues that come out of it, but that'd be my guess. You'd probably like to find something that, wow, great business, and we love this entrepreneur, and we're gonna get behind him, rather than, this is a great business, doesn't have the right team, I got to put in a new team. You just increase the risk on that success potentially.
Got it. Yeah, I just always found that, like, I don't know. Whenever there's an operator in a firm or at least a former operator, someone's been in the trenches, that we just speak the right language together, and they really, really get it. And as an entrepreneur, it's really helpful to have those kinds of people. I just don't see enough of it, And I've been fortunate to have a lot of operators kind of on my side, but around the league, if you will. I mean, you'd be surprised at the calls that I take from people that are coming up behind me in this cycle, and they have investors, and the questions they're asking me, I'm thinking, why aren't you asking them? And in some cases, maybe they're just too embarrassed and don't want to. But in other cases, like, I don't know that there's. I just think they're looking for that, that guide who has been in the trenches to help speak to them, and I think it'd be really helpful. So. Anyway,
for sure. And we do come across a lot of private equity firms that are understanding they want to have that operational capability, because it is something that you can really speak the language of the entrepreneur and be very value added and helpful, right?
Yeah, totally.
Not just a finance bro showing up with some money. You have a higher level of value add. It's pretty neat when it happens.
Yeah, I think it's beautiful when it happens. I just think there should be more of it. Anyway.
Yeah, for sure.
What are, all right, I've got two more questions for you that I want to make sure we get to. What are the common mistakes you see from entrepreneurs that want to pitch their brands? Or phrased differently, what are the mindset shifts that usually you have to coach entrepreneurs through when they come to you? Hey, Rodney, I think I want to go do X. I want to achieve it by Y. And then what are the common things that you kind of have to work through to help them level set?
Very good question. The first one probably is really understanding your business and where your brand is and where it's doing well and why it's doing well. That's like the first thing. There's a lot of people who are building a business and they're just out there selling product, but they don't, and they can say it's doing really well here. But when you ask them why or what's the demographic or the like, they're unable to articulate that. And we would think that's key, because you want to understand your brand, like I said earlier, where it does well, where it performs well, and why. And then you want to find those areas, right? And expand. It's pretty simple. I'm making it sound simple. It's much more difficult. But so that'd be the first thing, really understanding why are you successful, where you are successful, and how can you repeat that? That's probably number one. Number two, when we get in and we hear this a lot and people try to change our mind over and over and over, and it just, I gotta say, it's a broken record discussion we have, and I wish companies who are coming up, but it has to do with your P&L and how you're performing and what people look at. And we'll just lay it down here. It's net sales. It's not gross sales. I don't care about your gross sales only as an indicator of, kind of growth in the business, but it's net sales, what you actually sold. And people try to focus you on the gross sales and just know, but I know it's net sales. I know investors look at net sales, but gross sales. And you're like, okay, but you're never going to get there until you fix the net sales issue, right? So if you've got 30%, you can't point to the top line when you've got 30% gross to net difference and say you're going gangbusters. Someone's going to look at it and go, why are you discounting so much? Why is it 30%? Why isn't it closer to 18% given any category? It's a tough one.
Okay, hold on. This is too good. This is too good to pass up because I
didn't get in trouble.
No, you didn't. This is amazing because I talk about. I didn't know what trade spend was when I started in this business.
Yep.
And I didn't realize that you took that out of gross sales when you calculate net sales, and you take out that big lump in trade. And I was actually kind of mad about it, and mad thinking like, because that impacts your gross margin, right? So, net sales matter more than gross, right? And you need to make sure that the delta between them isn't this giant gap, right? Because that proves that you're just, if it's too big, what it might signal is that you're just supplementing your sales by over promoting it.
Absolutely. So if you think an investor's going to opine on your brand and try to understand where it eats, lives, and breathes, when that number's really big, it muddies the water tremendously to say, is it the promotions that they're responding to, or is it your actual brand? And are you building something that's, as we talked about, lasting and durable?
Yeah. Yeah. Okay. So then net sales become the number to focus on. You can speak to gross as long as you can say, my trade rate is reasonable and my gross to net is the number you referenced a second ago. You said 18%. It was a number. Is there a range that you see for high flyers?
Saying any given segment. What I can tell you is, well, it just depends on the category, right? It really does.
Yeah. Okay.
But what I can tell you is this: we see a lot of brands across categories in the 20 to 28% range, and we'd say that's probably fine when you're building and heavily promoting, but you have to have a plan to reduce that to probably the high teens-ish at some point. Now, some of the categories you won't have to do that much promoting and the like, but you'll get asked questions for sure when it's up in those upper reaches.
Okay, got it. Yeah, and and to your point, right? There's a time and a place sometimes for that, depending on the category, depending on what you're doing, and sometimes you need to be aggressive to go generate trial, and you need to be able to speak to that. But then you also need to have a plan to ratchet it down to what you would call a more reasonable rate, and then if you're speaking to investors, you probably need to be able to articulate and convince them that when you do ratchet that down, consumers will stay, right?
Exactly.
Yeah.
And you'll be able to see that in some of the promotional data, right? Where you see the big spike when you chart it and it goes up, and then your function kind of is pointing up and to the right, and you get some of that bump. And over time, you learn the cadence of that. You learn how it works. But just having it too high sometimes can be painful. But I was actually going... You dug in a layer deeper. I was actually just going to, a lot of people look at gross and then want to do valuation off their gross numbers, and they might happen really, really early. But as soon as you get to be a few million-ish or more business, it's going to be about net sales. Valuation is going to be off net sales, so you're going to want to focus on it.
Got it. Perfect. I'm glad you said that. It's a topic that I have not brought up yet, and I wanted to bring it up, and I might build on it in future conversations now that you've kind of broken the seal.
For sure. Yeah, and the other one's gross margin, right? Pulling your freight in and freight out down below, and some of the warehouse costs and the selling costs, and trying to keep them below gross margin. Most of the times you need to look at a fully loaded gross margin. So those products were made and landed, and what's the gross margin on that?
Yep.
And it's you can tell me all day long you have 10 or 12% in this other freight in and out freight line. The investors are going to take it and put it up above and say, no, you're not at a 38, you're at a 26 because it's 12% off of that. And owners and entrepreneurs want to say, but my accountants will let me do it this way. And and they sometimes don't listen. And the market's going to look at a fully loaded gross margin off your net sales.
Rodney, you said understanding why and where you're doing well, getting that piece right. And there are a lot of people that don't fully understand that. They're doing well, but they don't fully understand and can't articulate why. Yep. Okay. That's super important. And then on the P&L piece, being so important when going out for a fundraise. It's not just like what you think. We used to have this funny term early on that I called Jason's accounting principle. Jason's accepted accounting principles instead of the general accepted accounting principles. So we had JAP accounting. But that doesn't fly in this world. And I don't care what someone's opinion is. What the actual market says is that net sales are more important than gross sales, and then a fully baked gross margin. You've got to be realistic about that, and making sure that's buttoned up before you go to market, and really understanding it and knowing where it sits, and then knowing where it's going.
Absolutely. And so if you do the first and you sound like where your business is going, but then you get to the P&L and you're not really understanding the P&L and how the results of what you're saying work into the gross margin and the like, someone can look at your business and go, yeah, it sounds like they're doing an okay job, but their margins are a bit out of whack and they don't really have a plan to, improve those margins and get better, more profitable sales.
Yeah.
And so it comes back to bite you.
Is that something you work with? So my next question, and then I've got 2 or 3 rapid fires, and then we'll wrap it. Is that something you work with when you bring on entrepreneurs and you go, okay, they've got a pretty nice little business here, but maybe there's a few things they don't have dialed in. Does a firm like yours help them get that packaged up well? Absolutely.
That's one of the things we lean in and do some pretty extensive modeling and understanding their business and skews by profitability. And sometimes we've turfed up some pretty interesting stuff from the analytics we do that, hey, maybe this isn't as profitable as you thought it was. And so maybe you don't want to focus in that area as much as you thought you might.
Got it.
But yeah. And look, smaller teams who are just growing businesses and just, you remember what it's like the first 5 years, you're just responding and putting out fires. And so you don't have all this at your disposal, and you don't have often the time to sit back and go, hey, let me learn about valuation, and let me sometimes it's just a natural point where the natural way of things where you just learn on the fly. It's unfortunate though for entrepreneurs, lots of times they just learn in the context of capital raising that maybe they've been doing it a little bit wrong and viewing it a little bit wrong. Which doesn't always help.
Rodney, at what point should a brand in their cycle, when should they call someone like you? Actually, we've already answered that to some extent. If I think I want to raise money 6 months from now, when's the best time to call you? Now.
Yeah. So, and it's not self-serving to me or anything, but you should find an ecosystem or a group of people, and I know you do this, Jason, that you can just talk to about what's the market like, where investors, did you see some of these deals getting done? And the whole reason is for learning. And the more you can learn, and you want to be focused on your business for sure, but the more you can learn about what's going on out there and what are people looking at, the more you can say, hey, is that where we're headed? How do we differ? What would this look like? And you can, front end questions about your business and start to get an idea about what's really positive about your business, what may not be, what you have to work through. And so when you do end up going to market, it's not speed dating some bankers to find a good fit and then rushing out there. You kind of know what you need to know, and you've chatted with some people over time, and then you pull the trigger on it.
And then it takes a few months to get your whole package and everything ready to go, to really get the modeling done and right, and get the the entire SIM, if you will, put together that you can present to the rest of the market.
It does, like all in from just full start or standing start to finish. It's probably going to take you 6+ months, and on the front end, that's anywhere from 4 to 6 weeks ish to a couple months to get prepped if you really do it right.
Yep.
Unless you're super buttoned up, which most people aren't, because they're running a business, like I said, and doing extremely well, but they've got their day job.
Yep. Okay, that's really helpful. Rapid fire. Are there any trends in the CPG world that you get excited about, or any that you're bullish on for the next 24 months?
Wow, that's a good question. Protein. Protein is coming more front and center again. We're hearing it in a lot more conversations in all forms, in like meat snacks like you're doing, in powder form, in beverages. It's interesting where that will where that will continue to go. It's probably one of the more interesting categories right now.
Yeah, interesting. When you're in long days, when you're in the diligence process of a deal, in these long days, or prepping for going into diligence or anything like that, what are your go-to snacks? Are they savory or sweet?
I'm not a huge snacker. Mine's caffeine.
Okay. All right. So it's lots of coffee or other caffeinated drinks.
Yep.
All right. Fair enough. An acceptable answer would have been new Primal Meat Snacks, but I'll let you off the hook for that.
I realized that, but I wasn't going to take the bait.
Oh man. Okay. And then, what if there's one thing you could, if you had the megaphone and you could speak to all entrepreneurs in the CPG space right now and offer them, one really solid nugget of wisdom or guidance, what would you say to them?
That might take me a little while to think, but what comes top of mind is, like we said earlier, just build the most solid, healthy, durable, and sustainable brand and business you can. And assuming you're on that pathway, no matter where you are on the corporate life cycle, you'll find the right people along the way to help you at those various junctures if you're doing that.
Rodney, how can people find you if they wanted to get in touch or explore more opportunities with your firm?
You can look at my LinkedIn, at Rodney Clark on LinkedIn, or aspectconsumer.com is our website. So I'm out there. I'm always around.
Perfect. Love it. Rodney, there are some real great nuggets in here today, and I can't wait to share them with the world. Thank you for joining us. Thanks for being here, and thanks for sharing so openly and willingly.
Yeah, I appreciate it. Love being here. So thanks for having me.
Thanks so much.
Take care.